Hi guys, good morning everyone. This is Abid Khan and you are watching Karachians Academy YouTube channel. So we were doing past papers, CIE past papers of AS level accounting 9706. Paper 1, variant 2. So we have selected year 2022 and February March attempt. So till our last lecture we have done with question number 1 to 7. So you can watch these questions on our playlist. Today we will be doing question number 8. So move on to question number 8. Okay, this is question number 8. Right. What it says, the following information is available for business at 31st December. So this information is a closing information of 31st December 2021. Right. General expenses in arrears on 1st January. General expenses in arrears on 1st means they are outstanding or they are payable, having credit balance. Okay. General expenses in advance on 1st January, it means they are prepaid, right? Okay. Likewise, they have given general expenses in arrears on 31st. So this is again, this is they are outstanding or payable credit balance of closing. This is for closing balances, right? And this is advance prepaid on 31st of December, right? And what is required here, just see what is required here. Just hang on, let me open up my, just hang on, my Wacom. Just hang on. Right. Okay, now it's working. What is required? Total amount paid during the year. Total amount paid during the year ended December 31st, 11,500. Okay. This amount of general expenses have been paid, and what is the amount to be included in the income statement? They are asking you how much amount would be charged to the P&L or income statement, right, of general expenses. So this is very simple questions, and you remember how to make a subscription account. So this will be made same like as your subscription account, right? So you can make it here. Very simple general expense account. Okay, this is arrears 420 on 1st of January, balance brought down, right? This it is outstanding, right? And 240 is advance. This is prepaid on 1st of January, balance BD. And December 31st arrears means closing balance. So this is closing balance or outstanding payable. So it will have a credit balance. So credit balance at the time of closing we write on the debit side. Therefore, on 12th of December 2021, you can write the full date is 720 balance CD and 120 balance CD, and this 120 is prepaid. This is your asset, right? 120 on 31st of 12. Okay, very simple question. And they have paid 11,500. When you made payment, your bank got credited with 11,500 and general expenses debited with 11,500, right? So your expenses are, the paid expenses will 11,500, right? Bank, right? So we can see how much is, okay, $240, 11,500 plus 720. Total would be 12,460, right? If you balance it, if you at the time of closing, how much would be 12,460? Out of this 11,460, 420 you should minus, okay, and 120 you also need to minus. You need to deduct this 11,920. These are actually your expenses which you have charged to income statement. So your answer is 11,920. So we are done with question number 8. Hope this is clear to you. Move on to question number 9. What question number 9 says? Okay. What it says? When would the year-end value of inventory need to be adjusted? He is talking about the inventory, its adjustment at year-end. When inventory has not yet been paid for, this is not applicable. If you got the inventory, you made purchases, okay, and leftover is your inventory. So whether it is paid or not paid, this will be recorded, because we are doing accounting on accrual basis, not cash basis. So this is absolutely wrong. When selling prices has fallen below cost, okay, we can discuss this. Okay, so this option 1 is in this. Option 2 we will discuss in detail. When the owner has recorded taking goods for his own use during the year. When the owner has recorded taking, no, it is not. Ultimately it is not, because when when he takes the goods from, it is drawing. So drawing debited and purchases are credited. It has nothing to do with inventory, right? So inventory. Now we got option number 2 left over. So this is your answer, but I would like to explain you. When selling price has fallen below cost, yes, you know, International Accounting Standard 2 IAS on inventory, what it says means you, while it talk about this IAS talk about the inventory and all aspects of inventory, its methods and its valuation. And on valuation it says whenever you do valuation of inventory, it should be taken as lower of cost or NRV. NRV, what is NRV? NRV is the selling price less selling cost. If you are incurring some cost on selling, you have to deduct that. So NRV. So what actually its selling prices has fallen below cost means what is less than actually this business is maintaining its inventory on cost or whatever it, but when they are valuing the inventory, cost of certain items have fallen to below, selling prices has fallen below the cost. It means those inventories you cannot sell them. They will be sold on lesser than the cost value. So now you have to value your inventory and see and take the lower one. So lower of the cost or market. So your answer would be 2 only. Your answer would be C. We have done with the question number 9. Move on to question number 10. Okay. Move on to question number 10. A business had a draft profit of 250,000. The following errors were then discovered. Actually, this is draft profit, and after calculating the profit at the later stage, some errors were discovered. Depreciation charge was 25,000. Okay, it means when you calculated this profit, you deducted depreciation with 25,000. The figure should have been 40. Okay, they are saying it should be 40. It means you less charge expenses with 15,000. Very easy and very much clear. Closing inventory for the period was undervalued by 10,000. Okay, remember one thing on closing inventory. Closing inventory has a direct relationship with profit. If you hire the closing inventory, higher the profit. Likewise, lower the closing inventory, lower the profit. Lower the profit. If your closing inventory you overstate wrongly, erroneously, then your profit will get in, because and if you are understating your inventory, undervaluing it, then your profit will decrease, right? Because ultimately, if you are increasing your inventory, your cost of sales will decrease and your profit will increase. It has a direct impact. So it means this 10,000 you have undervalued. Undervalued means the closing inventory for period was undervalued. Undervalued means you means decreased your profit, right? Here what you did, 15,000 you increase your profit, right? So what was the correct profit for the year? If you calculate correct profit for the year, the 250,000 was your draft profit, plus this 15,000 actually the figure should have been okay, not in, you have you already increased because you less charge, now you have to more charge. So this 15,000 actually we have to you have charged 25,000, right? And you were to charge 40,000. So there you less charge 15,000. So 15,000 you have to deduct from your profit. Your profit was overstated, right? And what about this? By 10,000 of inventory undervaluation, you undervalued or you understate your profit. So you 10,000 you have to add. So how much the answer would be? 250 and 245,000. So your answer would be B. Okay, we are done with question number 10. Move on to question number 11. What 11 says? Question number 11 says a capital account for a sole trader contained 3 entries in addition to the opening and closing. Okay, opening and closing entries are already there, and there are 3 entries. What did these 3 entries represent? On debit side, on credit side, the 3 entries he is talking about. The capital introduced, drawing and option A, B, C. He has given you different options. Okay, so we can see different options, but you just remember one thing. If your concept is clear, then you will easily be able to, select the correct answer, capital account. He is saying the opening and closing entries are already there. So if I say you have opening balance of some 100,000 and your closing balance of 31st 12 is 150,000. So closing balance, the credit balance will appear on at the time of closing on the debit side, right? So 100,000 was your opening, was your closing. So you remember, now there are three entries which you normally do. If you doing a drawing, if I say 55,000 drawing, so what entry you will make? Drawing, if you're drawing some cash, so this drawing will get adjusted with your capital. What the next entry would be at the closing of the year, what you will do, you will do capital debit and drawing credit. You have to close this drawing with 5,000. So it means number one entry is drawing, which will appear on the debit side. Number one thing is this. If you introduce some additional capital, what entry you will make? If I say some 50,000 you have introduced, you will do debit bank and credit capital, right? With the additional capital, your capital will get increased. Second entry is additional capital. When you got the profit or loss, if there is a profit, then the profit P&L will get debited and your capital will get credited, right? Or whatever the amount is, if I say some 10,000, or if there is a loss, then your capital will get debited with this 10,000 if it is a loss, right? And P&L will get debited, right? So the profit, if there is a profit, it will increase your, or this profit or loss would be one entry. Either it will be profit, either it will be loss. So now we see what options are given. A, capital introduced on debit side is right. Capital introduced on debit side, no. Capital introduced appear on the credit side. This is wrong. You straight do not consider this. A is absolutely wrong. Capital introduced debit side and drawing debit side. Drawing is right, but this is wrong. So this option, I am not seeing this one, because on first it is wrong, then whole option is okay. Drawing is debited. Yes, drawing is debited. This is correct. Loss, exactly, loss. This is a profit, and in case of a loss, either this will be profit or this will be loss, right? So loss will be debited for the year, right? This is okay. Capital introduced, exactly, capital introduced. So this is the best, this is the correct option. And the profit for the year debited and capital introduced, credited, drawing is wrong. So this whole option. So your option is C. Okay guys, so we have done with the question 11. So in our next video we will start with question number 12. So that's all for now with this video, and please connect with us in the next video. Thank you very much and bye for now.